Today we're going to talk about the importance of investing in high quality companies. Quality is a frequently used term in investing, but from Magellan's experience, definition really does matter. Not all company fundamentals are the same. Most give you an indication of where the company has been, but not necessarily where it's going. Quality, in our opinion, isn't just looking at historical ratios. We're looking at company fundamentals with a forward-looking lens. The future prospects of a business are more nuanced and require taking into account the qualitative attributes of a business. I started at Magellan in 2015, and it's been very clear from the beginning that Magellan's DNA is different. Magellan is focused on investment process and in the investment team. Specifically, it's how we identify a quality company. This evaluation isn't downloadable or traceable. It's deep fundamental research where we are collating and analysing information from a wide range of sources to make a determination of quality. This is a learned skill that our investment team has been fine-tuning for over a decade. At Magellan, we define a quality company as those that have unique attributes that enable the company to earn attractive, sustainable returns over the long term. Some of the characteristics that we're looking at are on the left-hand side of the slide. Whilst a company is unlikely to have all of these attributes, the more attributes they have, the more resilient the business is likely to be. Let's talk to some of these attributes. Barriers to entry. How hard is it for a new entrant to be more competitive and to take market share? A great example is Microsoft. It's a leading software suite and cloud provider, and there are few true competitors to their offering. Next is brand. How much cachet does your brand carry? Does the brand represent trust or quality? Another example here is Nestlé, and it has a suite of #1 brands in the food and beverage industry. Network effects is another quality attribute. Do all the participants benefit from being in the network? This makes it harder for customers to switch. Visa and MasterCard are the largest global payment networks and the epitome of a network effect. Next example is scale. Does the bottom line benefit as the company grows, improving its leverage? McDonald's is an example of scale. It's the largest restaurant chain globally. We're also looking at companies and their exposure to business risks and management quality. But it's not all about definition. It's how we execute on that definition that's really important. To apply the definition, we undertake fundamental research. We peer review via investment committee, and then we continually review our thesis. The best way to explain quality is via a real-world example. As we just mentioned, Visa is the largest payment networks in the world, and a company we view to be high quality. Visa and MasterCard are the only truly global networks, connecting consumers and merchants in over 200 countries globally. The scale of their network is unrivaled, with Visa, for example, connecting 3.9 billion cards to 80 million merchants globally. Visa is the epitome of a network effect. Visa's business strengthens as the network grows. For example, every merchant benefits from the addition of every card user and vice versa. Replicating such a network as this would be costly and time-consuming, not to mention the importance of maintaining a functioning payment system and the trust and reliability that the Visa brand represents. The barriers to entry here are very high. These attributes enable Visa to have the strongest operating margins in the S&P 500 index. So hopefully you can see through this extensive research, we view that Visa is a high-quality business. So far, we've described what quality is and what quality looks like in a company. But let's unpack the why. Why quality matters and how it will lead to superior returns. So why does investing in quality matter to you as the investor? From our experience as quality investors, there are 3 key reasons why. First, you can have greater conviction in the sustainability of the company's earnings. This gives you greater certainty in your investment. Second is that these earnings compound over time, which generates you, the investor, a sustainable and attractive return. And then finally, quality allows you to invest through the cycle. It's a really important feature when we know with certainty that volatility will present in our investment horizon. We're going to provide an example of each of these points, hopefully solidifying why quality in investing matters to you. To do this, we're going to use the example of Visa that we just spoke about. Remember, it's a quality company that benefits from network effects, scale, industry positioning, and barriers to entry. So, on to that first reason on why quality matters to you as an investor. Quality companies give you greater conviction in future returns. Here are two companies that are in the transfer money business. These are brands you've likely heard of and you probably have used. We have Visa and Western Union. Let's compare and contrast them. Both companies have a long history. Visa started in 1958 and Western Union, would you believe, back in 1851. As we spoke about with Visa, it's connecting 3.9 billion cards and 80 million merchants globally. Visa is a global digital payments railroad, and as we've discussed, scale, network effects, barriers to entry and brand. Western Union, it specialises in money transfers from consumers to consumers. It too is in 200 countries, but it has only amassed around 9 million customers. Western Union, yes, it has a brand, it has scale, but it's been focused on the remittances of cash and it wasn't focused on digital transactions. Its quality continues to erode in our opinion. A peer recently came to market TransferWise that is also in remittances. It's been around for 12 years and in that time it has nearly 6 million active customers. As you can see, the barriers to entry are lower in digital remittances. But what about the future? Visa we view to have a positive trend. There are structural tailwinds and there's cash digitisation. Visa has continued to invest in its business to defend its economic moat. When you compare that to Western Union, it has a negative trend. That underinvestment in the digitisation of remittances means that we're less certain about the future of its earnings. The second benefit of investing in quality companies is that they can reinvest earnings over time. This leads to compounding. Now, we spoke to the importance of Visa's network effect on the previous slide, but here we're plotting the evolution of the network effect against its share price. Visa has continually reinvested in its business, innovating, which then protects its quality factors and generates sustainable returns for investors. Visa has grown its volumes nearly 300% in the past decade. It's more than doubled its merchant numbers and doubled the number of card users. This allows for compounding, and as you can see on the chart, it's favourable for shareholders. Over the past decade, shareholders have generated a 19% annualised return. And that return looks even more impressive when you compare it to the index, which has a 7% 10-year CAGR, and Western Union at 0%. And the final reason why quality matters is that it allows you to invest through the cycle. Now, as we've noted, quality companies have sustainable earnings. This means that they're more resilient through the cycle. And in many cases, it means that they can come out stronger. Quality companies can often reinvest through the cycle, which lower quality companies often struggle to do when the cycle turns. Their cash flow is needed to keep the business operating, and then the reinvestment suffers. Again, we're presenting Visa. Now we've zoomed in to the last 5 years to really highlight the impact of extreme market uncertainty, which was presented by COVID. Visa's share price dropped 19% in the first 3 months surrounding COVID. Now we fast forward to 2021, and we saw a challenge to Visa's quality, Amazon. Amazon was threatening to exclude Visa as a payment method due to pricing. Now, whilst the tension went on for many months, it ended up being resolved. Why is that? Amazon needs Visa. Amazon tried to incentivize customers to use other payment methods, but it didn't work. Visa's network adds values to consumers, but also to the merchants that use it. Now we fast forward to present day. Visa has generated returns of 13% per annum over the past 5 years, whilst the index, which includes the quality companies and then the rest, has generated only 6%. Investing in quality means you can invest through the cycle. This is an important attribute given we know with certainty that uncertainty is on the horizon. Additionally, it's important to give these companies time to reinvest in their business and create long-term shareholder value. If you just focus on the short term, you miss out on that compounding opportunity. You can look through the noise when you're investing in a quality company through the cycle. Overall, quality fundamentals shouldn't be ignored in investing. But importantly, definition really does matter. It's important to look to the future when defining quality and not only to use historical data. Historical data doesn't capture the nuances of a quality company and how they can sustainably generate attractive returns. Looking to the future when defining quality, it gives investors greater certainty in their investment through the cycle, and it allows shareholder returns to compound. Thanks for listening in today. It's been great to talk to you about why quality matters. If you have any questions, please go to our website at www.magellangroup.com.au.